Hey, welcome. So if you're watching this, it means you're serious about improving your day trading game, or you're just looking to learn a specific day trading strategy. So the one I'm going to share with you in this video is the opening range retest strategy. It's honestly a strategy I've been playing for about 2 years now. I did a lot of back testing and it's just amazing. The results are there and it's super simple, super straightforward and easy to understand. So in the next hour, we're going to break it down together. We're going to see everything from A to Z, all you need to know how to apply that strategy. So without any further ado, let's jump right into it. So let's start with the introduction of the strategy. So you might be wondering, what is the opening range retest strategy? So the opening range retest strategy is a high probability setup that occurs after the initial breakout of the opening range. So instead of entering immediately on the breakout, we will wait for a pullback, which we call the retest, to the breakout level before entering the trade. So it's a strategy that provides a really good risk to reward. It reduces false breakout entries and allows traders to capitalize on stronger continuation moves. So why I think this strategy works so good? I see really three main edges with this one. The first edge is that market makers and institutions often test key levels before pushing the price further. So you're going to play with those big players. It's like those guys are big whales and you're going to just stick to them like a little fish behind them and just follow their move. And that's super important in day trading. You want to follow those big players, not trying to fight against them. The second edge I see with this strategy is that it reduces the risk of false breakouts by confirming price strength at key level. So if you've been trading for a while and you experience some strategies like the opening range breakout 1 minute or 5 minute, I'm sure you've been in those situations when you get chopped up a lot of times. So you enter a trade, you take a loss, you enter it again, you take a loss, and the price action is just going sideways. Well, this strategy is going to help you avoid those kind of trades where you have a lot of losing trades in a row because you're waiting for the true breakout. So again, the goal of this strategy is patience, and the strategy is built around patience. So that's why I really like it. And the third edge I see with this strategy is that it provides a better entry price compared to chasing the initial breakout. By the way, if you don't have any experience with trading, you're new to the game, and you're a little bit confused about all those concepts, all those words I'm using, just stick to the presentation and hopefully by the end, everything will be more clear. So let's get back into it. So market conditions where this strategy is the most effective. What I really like about this strategy is that it's super effective in any kind of markets. It's good in bull markets, so when everything is going up. It's good in bear market when everything is going down. And even when the whole market is trending sideways, you will still be able to find some really good opportunity within this strategy. Where it works the best is when you have strong trending stocks. And either you're in a bull market, bear market, neutral market, you can always find those strong trending stocks. So that's what you're looking for this strategy. So you want to see high volume, a lot of liquidity for potential big movements. Earnings season, for sure, it's great to apply this strategy because within earnings season comes a lot of volume, a lot of volatility. And for sure, on any kind of bullish or bearish news, this strategy works amazing. Here are the ideal assets and time frame I use for the strategy. So I only trade large cap stocks. So I mean big companies like Tesla, Apple, Amazon, Microsoft, those big companies, that's where I feel like the strategy works the best. I honestly never experimented on low float stocks. So everything on penny stock under $10 a share, I never experimented. Maybe works good, but in terms of risk management, especially if you're starting trading, I really recommend sticking to those big companies. It's a strategy that also works really good on futures or indexes. So if you like to trade the NQ or ES, will work amazing. If you like to trade the NASDAQ or the SPY, will work really good on those markets as well. So any kind of stocks with high liquidity, I think that's the niche. That's where the strategy had made really a lot of proof for me. And lastly, the time frame I use for the strategy is the 1 minute chart. So keep things really simple. All you need is one time frame. So only the 1 minute chart for your execution. That's all you need. So let's try to keep it as simple as possible here. Now let's jump into the fun part of the presentation, which is the key setup criteria. So everything you want to see before entering the trade. So the first step, which is super important to identify, is the opening range. So like the name of the strategy is saying, it's the opening range break and retest. So the first step, identifying that opening range. So what I mean by opening range, the opening range is basically the distance in between the high and the low of the first 1 minute candle. So what I mean by a candle, if you're new to trading, a candlestick, it's what you see right here. So this is a candlestick. So it's made of a body and wicks. And a candlestick is always telling you four really important information. It's telling you what is the low of that 1 minute, what is the open price of that 1 minute, the close, and the high. So four information, and all those information are really telling you a story here of what's happening during the time frame of 1 minute. So if we look at the chart here on Apple, by the way, this is the 1 minute chart. So each candlestick is worth 1 minute. So the first minute of the day, we saw that the price opened right here. We saw that the price pushed all the way here, made a high. It went all the way down here, made a low, and it closed right here. So here we have four information. And to identify the opening range, we want to look at the wicks. So the distance in between the high and the low here. So this is our opening range. Pretty straightforward. So you mark the distance in between the high and the low of that minute. Really important to use the wicks here. We don't want to use the bodies. So after we identify our opening range, we're going to need another indicator, which is called the VWAP. So the volume weighted average price. So this indicator on the chart looks like a line. It's like a moving average. So if we look at the charts we have here, it's the black dotted line. So it's usually a line that follows the price. And usually how you want to understand the VWAP is that the price, when it's under the VWAP, will probably continue to the downside. And if the price is over the VWAP, it will probably bounce and continue to the upside. That's basically how you want to read the VWAP. So the way for this strategy we want to use the VWAP is that we want to be short if the first minute close under the VWAP, and we want to be long if the first minute close over the VWAP. So here's two examples. The first one is we want to be short. So if we look at the first minute, we draw our opening range, which is the green box I have on the chart here. So we have the distance in between the high and the low of that first 1 minute candle. So where that first minute candle close, for the close, we need to look at the body of the candle. So the candle closed right here. So it opened here, closed here, and went all the way down here. So we want to make sure that the close of that candle is under the VWAP for a potential short. If we compare it to the second screenshot I have here, which is the opposite. So we have the VWAP here, and we have the first candle that closed right here. So we saw a candle that closed over the VWAP, so we're long bias, looking to play the trade to the long side, so buying. So this is exactly what you want to look for after identifying the opening range, and it's going to dictate the direction of your trade. So if the candle closed something like that, we want to be long. If the candle closed something like that, we want to potentially be short. And that will lead us to other criteria that we're looking for. But so far, we have those 2 points. So first, identifying the opening range. Second, identifying if it closed under or over the VWAP to have our direction. Now, after we have our opening range or potential direction, what we're looking for is a breakout. So we want to see the price break outside of the opening range and move significantly in one direction, closing a minimum of 3 candlesticks in a row over or below the opening range. So if we look at the first example here on MSTR, so we have our opening range, so the distance in between the high and the low of the first 1 minute candle. And after that, we want to see the price break out in one direction with at least 3 candles in a row. In that case, we have 1 candle here, 2 candle here, 3 candle here. So after this third candle, we know that it's a valid breakout and we can potentially play a trade to the long side. And what I mean about 3 candles closing over the opening range, super important to look at the body of the candle, not the wicks. Because if we look at the second example here on NVDA, we have our opening range. Then first attempt here, we have 1 candle that closed outside of the range. Second candle here, back inside the range. So that's not a valid breakout, is missing 2 candles. Then we have another attempt here, but actually no candle close outside of the range. All we have is a wick. But like I said, we need the body to close outside of the range. But the body of this candle is still inside the range. So that's another false breakout. Then here we had a third attempt. So we had one candle here, the second back inside the range, false breakout. Then we tried again here, one candle here outside of the range. The one after that, boom, inside the range, another false breakout. We had another attempt here, one candle outside of the range, the other one back inside the range, so another false breakout. So that's what's great about this strategy. You're able to avoid all of those false breakout. So for the first 45 minutes of the day here, NVDA went nowhere. It just traded sideways. And this strategy allows you to stay away from that choppy price action, waiting for the price to actually show you some kind of movement, which is what happened right here. So we finally had the breakout with one candle, two candle, and three candles in a row. Valid breakout. Now we can potentially play the trade to the long side. So that's what you want to see in terms of breakout. So that leads us to the last step, last criteria you want to see, which is the retest. So again, like the name say, it's the opening range break and retest. So we have our opening range, we had the break with three candles in a row. Now what we want to see is the price retest. So we need to be patient and wait for the retest of the opening range. So we want to see the price pulls back to retest the breakout level. So the previous high or low of the opening range. Super important here on the retest, you don't want to see any kind of abnormal volume spike. Really, really important to pay attention to the volume. And the retest of the opening range must happen before 10 a.m. So you basically only have 30 minutes to play this strategy, like super small time frame, but that's what's great. It's going to free up the rest of your day to do whatever you like. So at 10 a.m., you know you're not going to enter any more trades. The only thing you will do is nurse a trade that you're already in. So really nice to only have small time frame to play the strategy. So this is a good example here on the MSTR of the kind of retest you want to see. So if we recap a little bit since the beginning, we draw down our opening range, distance in between the high and the low of the first 1 minute candle. Then we have valid breakout with one candle here, two candle here, three candle here. So we know that it's a valid breakout. All we want to see after that is the price retest that opening range, which happened a little bit later here. We saw a really nice move to the downside, retest that line, and bounce from there. And we can see here that on the retest, the volume was really low. That's exactly what you want to see. A nice indicator to have on your volume is the gray line I have here. So this gray line represents the average volume. So on the retest, you want to see those candles, those volume bars below that average line or right on it. You don't want to see any kind of volume bar that will have looked something, let's say like this here. That would have been a red flag and I would have stayed away from the trade seeing that. So you want to see a low or normal volume on the pullback. So this is exactly what kind of retest you want to see. And after seeing that retest, well, you're almost ready to enter the trade. Before jumping into the execution of the trade, so how you want to enter, how you want to manage the trade, get out of the trade, where you want to place your stop loss, I want to share with you a specific indicator that I use for this strategy that I will say is not necessary 100%. Like the strategy, even without it, would work really nicely. But if you're able to understand and it's not too much noise in front of you to add that specific indicator, you're going to see that it's going to help you have a way better win rate. And it's going to help you avoid a lot of trades you shouldn't be taking. So this specific indicator is the Camera Pivot Point filter. So basically, you don't want to be short in between S3 and S4. And you don't want to be long in between R4 and R3. So if you're new to trading, you might be super confused about what I'm saying here. So let me explain it in a really simple way. What is that Camera Pivot Point indicator? So it's basically 4 lines that you're going to have on your chart. You're going to have R4, R3, which stands for resistance 4 and resistance 3. And then you're going to have 2 more lines, which is S3 and S4. That stands for support 3 and support 4. So we have 2 support line, 2 resistance line. So far, so good. And the way you want to read this camera pivot point is that everything in between S3 and S4 here, it's called a buying range. So it's a range where you have more chance of going back up. So if the price comes down in between those two lines, you have good probability to come back inside the range like this. And everything in between R4 and R3, well, is the opposite. It's a selling range. So it's a zone where you have a good chance, good probability of going back down into the range. And usually the way the cams work is that the price will just fluctuate like this in between S4 and R4. Not always, but most often than not. And when you have the price over R4, well, there you want to play it for a bounce higher. And if it's under S4, you want to play it to the short side. So basically, you want to be long right here. You want to be short right here. You want to be long right here. And you want to be short right here. That's basically the way the camera pivot point indicator works. So if we draw an example together, let's say we have our first minute opening range closing something like this. And then we mark down the high and the low. Let's say after that, we have a breakout with 1 candle, 2 candle, and 3 candle. We have valid breakout. And then after that, we have our retest. So the price is starting to go back down. And then retest that opening range here. So all the criteria are respected. So here, usually we will go long for potential bounce higher. But for the only reason that we're in a selling range here, and we know that in a selling range, the probability of going back down are higher than going up, we're going to avoid taking this trade. So that's the way you want to filter a lot of trades where you shouldn't be taking because the probability are against you. Hopefully by now you're starting to have a good understanding of the strategy and that you're not too lost and everything is explained in a simple way. If it's still a little bit confusing for you, just stick to the presentation. By the end, I'm going to talk and show a lot of different trade examples showing the chart, the mindset behind it, and what I've seen. And hopefully by then we'll be more clear. So now let's jump into the trade execution. So everything in terms of entries, exit, and how to manage the trade. So in terms of entry signals, entry step, the first step, we want to see the break of the opening range with minimum of 3 candles in a row. Then you want to see the pullback with low or normal volume like we saw together towards the opening range, and really important, before 10 a.m. 10 a.m. means Eastern time, by the way, so 30 minutes after the market open. And the last step, you want to enter either on a 1-minute high or low, or as close as you can to the opening range. So you have two options here. So it's either you wait for a 1-minute high or low for more conviction. If you wait for that, you're going to have a better win rate, but your risk to reward will be a little bit further. So where you're going to place your stop will have a little bit more distance. So you're going to have to let the trade run a little bit longer. Compared to if you enter right at the opening range, there your risk to reward will be quicker to reach. So two options work. Personally, the way I played it in the beginning, I was waiting for a 1-minute high or low. And the way I play it right now is that I don't wait for a 1-minute high or low. I enter as close as I can from the opening range. That way my trades are a little bit quicker. So both options are good here. It really depends of which one you feel most comfortable of. But like I said, with all the example I have at the end of the presentation, we're going to see a mix of both. So waiting for a 1-minute high or low, or entering as close as possible to the range. And we're going to see the difference together. Now, how you want to place your stop loss. So here, really important to understand the difference in between a hard stop and a mental stop. So a hard stop is when you have an order placed in the market the moment you enter. So if the trade don't go in your direction and go towards your stop loss, you're going to get out no matter what. The market is going to fill it for you. Compared to a mental stop where you need to do the job manually. So if the price don't go in your direction, arrive close to the area where you should get out, well, you need to go manually and click sell the rest of my position, or cover, if you were short, cover the rest of my position. Honestly, I use hard stop. Since I started trading, always been hard stop, just for the fact that the psychology part with hard stop is a lot easier to handle. When I use mental stop, let's say for example, you lost 3 trades in a row. You're in your 4th trade, you have a mental stop, price don't go in your direction, you're frustrated, you're mad, you're seeing yourself losing money, and you have difficulty to accept it. So having a mental stop, you need to do the work to go click manually and take the loss again. So a big part of you might say, I know I'm not going to take my stop loss. I'm just going to give it a little bit more room, just a little bit more room, add to my position maybe. And that way you end up with massive losses. So that's why I feel like having a hard stop the moment you enter a trade is a good way to protect your capital. So that's my recommendation, but doesn't mean there's one that is better than the other. It really depends of yourself. So I will place the stop loss at the opposite side of the first 1 minute candle range. That's the first option. So what I mean by that, let's say you entered a trade here as close as possible to the opening range. You could have placed your stop loss at the opposite side of the opening range. So below the low of the first 1 minute. That's the first option. The second option is to place it under the VWAP. In that example here, we don't see the VWAP, but let's say that the VWAP was doing something like this here. So like we saw, the VWAP is usually following the price. So enter here, the entry is the same. Instead of placing your stop loss right here, you could have placed it right there, just a little bit under the VWAP. So what is that going to change? You're going to have a little bit less room here. That means that to reach your target, you're going to reach it a lot quicker than if your stop loss is here. So 2 options are good here. What I will say is that if you decide to place your stop loss right here at the opposite side of the range, your trade is going to take longer. So you're going to need more patience. If you're someone who likes things more quick, more like closer to a scalp, I recommend place it under the VWAP for a more rapid trade. But like I said, 2 options are good, and I think it's worth to experiment both to see which one you feel more comfortable with. Personally, when I started playing this strategy, I was placing my stop right here at the opposite side of the range. And not too long ago, I switched it to under the VWAP because I'm starting to like those quicker trades. So that's the way I do it lately. Now, let's see together how I manage my profit targets. So how I want to scale out of a position. So really important rule I have here is only start partialing at 2R. So what I mean by 2R, I mean twice my risk. So if we look at the example here on MSTR, let's say we entered right here. So the distance in between our entry and our stop loss here is worth 1R. So if the price don't go in our direction, it goes against us, we're going to lose 1R here. Then if the price start pushing higher, like we saw here on MSTR, we're going to reach 1R in profit here and eventually 2R in profit here. That's where we want to start to sell. So really important to wait for twice your risk to have a profitable system. After you took your first partial, really important rule as well is to put your stop loss to break even. Really important if you don't want to have any kind of big emotional spike, seeing the price, seeing yourself in profit, and your profit turning into losses. That's hard to manage, and that's why I have this rule. Then you want to keep scaling out using important support or resistance level. For that, you can use the Kamala pivot point. Really good way to start scaling out of a position. Let's say on MSTR, we have R3 here. Let's say this is our cam level resistance tree. Let's say we took our first partial here, and then a couple minutes later, we're seeing the price push higher. Here, you can start to take more off the table. So using the cams, you can also use daily level if you like, or just rounded numbers. Let's say you're trading Tesla, maybe at 260, you can take a partial at 265, 270, and so on. So that's the way I manage to take my profits of a trade. Now, before we jump into a bunch of live trades example that I took in the past, I would like to share with you and talk with you about some common mistakes I see with this strategy. So I feel like being aware of those patterns is going to help you prevent a lot of mistake in the future. So the first one I see repeating often that I experience myself as well is misidentifying weak breakouts by not waiting 3 candles in a row. So you will have some situation where, let's say you spend the first 15 minutes of the day not finding any trades. you have that rush of wanting to take the trade because it's super hard to stay on the sidelines. And then let's say you say one candle closing outside of the range, two candles closing outside of the range, and the third one back inside the range. You might be tempted of entering the trade, but you should stay away from those situations because more often than not, it will just turn out into choppy price action. The second common mistakes I see often is FOMO, so fear of missing out, so entering the trade too early. So that's a little bit similar to the first one of misidentifying the breakout. So that happens really often in trading in general. The third one is ignoring volume signal on the pullback towards the opening range. So like we saw with the criteria of the retest, really important to see normal or lower than average volume. If you see a spike of volume, it's super easy to don't pay attention to that, and it's going to lead you to a lot of losses. Really important to read the volume here. Then ignoring the bias using the Camilla pivot points. I wouldn't say that one is a mistake because you don't necessarily 100% need that indicator, but it's an indicator I recommend using. It's going to filter a lot of trade, and that's something I use. But if you're starting trading, you want to start practicing this strategy, it might be too much noise in front of you. So not paying attention to it, not having it in your charts in front of you is not necessarily a bad thing, honestly. Then placing your stop loss too tight from the entry point. Let's say you see the price forming the opening range, breaking outside of the opening range, coming back to retest it. You enter the trade, but you place your stop loss super, super close to your entry to be able to catch your profit really quick. You should be careful here. I will say the closest you can put it is on the other side of the VWAP. Really careful here. You need to give it a little bit of room because you want the trade to take at least a minimum amount of time. Like you need some patience here. Really important. And the last common mistake I see is scaling out of the trade too quickly. That happens to me often. That happens to a lot of traders. If you've been trading for a while, you know exactly what I mean here, is not waiting for your 2R, so twice your risk in profit, and starting to scale out earlier. This is not going to affect necessarily the result you're going to see in your daily. You're still going to see some green. You're still going to see some profit. But if you analyze your results over the long run, let's say more than a month, it's definitely going to affect your system. For your system to be really profitable with that strategy, you need to wait for at least 2 hours. Super important. So those are the main common mistakes I see with this strategy. And like I said in the beginning, super important to be aware of those. And I can promise you that you will go through all of those mistakes. I still do. It's really normal, but you just need to start being aware of those and understand the way you react to those mistakes. In this last section of the presentation, I want to share with you a bunch of live trades breakdowns that I took in the past to show you how this strategy works, to explain it hopefully a little bit better, and to show you that it really works really nicely. It's some patterns that I see repeating every single day, and they're super straightforward to apply, recognize, and execute. So the first example I have here is on NVDA. So first step, like we saw together, marking down the opening range. It's the gray box I have on the chart here. So this is the distance in between the high and the low of the first 1 minute candle. Then we saw that candle just a little bit close over the VWAP. So we are long bias here, looking to play the trade to the long side. So here we saw the price trying to break out, one candle, the second one back into the range, false breakout. Then another attempt here, we saw one candle outside the range, two candle, three candle. So that's a valid breakout. Now we want to see the price retest towards the opening range, which is what we saw right here. The reason I didn't enter here is because I didn't like that the volume was slightly above average here. So I stayed away from that one, even though an entry here would have worked with a stop loss on the opposite side of the opening range. But nonetheless, I stayed patient here. I decided to wait a little bit longer to see a better setup forming. And it's exactly what we saw right here. So we had another breakout with one candle, two candle, three candle. So that's valid. And we had a nice pullback towards the opening range, and that time really nice decrease in volume, lower than average, exactly what I wanted to see. So here in this example, I entered on a 1 minute high, placed my stop loss Two options here, either under the VWAP or below the opening range. And we can see that I reach 2R of profit here and a little bit more on the way up. So good example of the strategy on NVDA here. So we can see like the first, 30 minutes of the day here, price action pretty choppy, going nowhere until we have a nice breakout, a nice decrease in volume on the retest, and boom, finally the move up is happening. So patience paying off on that one. Let's see another example here on Tesla. So same concept, we mark down the high and the low of the first 1 minute, which is forming our opening range. By the way, if you're using the platform Dash Trader Pro to trade, you have a specific indicator which is called the opening range, and it's gonna draw that box automatically for you. I don't know about other platforms, maybe they have the same indicator, but really useful. You don't even have to do it manually. So if we go back to Tesla here, so we mark down our opening range and then we wait for a breakout. We had first attempt here, but this candle closed back inside the range, so false breakout. 1 minute later, we had one candle here, two candle here, three candle. Excellent, that's a valid breakout. And then we wait for the retest to the opening range, and then we can enter to the long side. So exactly what I did here on Tesla, enter here, stop loss here, and reach nice profit of 2R. After taking a partial, we can see here that my stop loss was placed at break even. So if the price decide to reverse on me and go all the way down here, I will get out of the position and walk away with a decent profit. Here's another good example on MSTR, which is the example we saw during the presentation. It's actually a trade that I took. So we saw a nice breakout with one candle, two candle, three candle. That's valid. After that, you want to see the price retest the opening range, which is what we saw right here. So stop loss here, or you could have put it a little bit under the VWAP and you catch a nice bounce to the upside here. Here's a good example on Uber. So we can see that the first candle of Uber formed the opening range. We saw that this candle closed under the VWAP. So we want to take the trade here to the downside, so going short. So we need to wait for a valid breakout with at least three candles in a row. So we had one here, two here, three here. Good, valid breakout. The next and last step we want to see is a pullback towards the opening range, which is what we saw right here with lower than average volume. Excellent, all the criteria are respected. So I entered to the short side here. My stop loss was, again, two options, either a little bit over the VWAP or on the opposite side of the opening range. In the two cases, the trade would have worked out really nicely with a first profit target at 2R. Here's another good example on Tesla. So we can see that Tesla formed the opening range. Then we can see that the price broke outside of the opening range with one candle, two candle, three candles in a row. And after that, we had the retest. So the price in that case just stayed in the same level, but nonetheless, you can consider that as a retest. The volume was low. And finally, we had the break to the downside here. Here, it's important to mark one little detail. We can see that the first 1 minute candle here closed over the VWAP. So we saw in the presentation that when we see a 1 minute candle closing over the VWAP, we want to play the trade long. But in that case, I played it to the short side for one reason. For the only reason that when I entered, the price was under S4. So if you use the camera pivot point, we know that below S4, we want to be short. So that's why I entered a trade. I will say that not respecting the VWAP side here, it was maybe a red flag, made the trade not optimal, but nonetheless, I took the trade. It's not because I designed this trade book, this strategy, that I apply it the perfect way. I still do some mistakes with it, and that could have been a mistake even though the trade worked. Here's another trade book example on AMD. So we have our opening range, distance in between the high and the low of the first 1 minute candle. We see that that first minute closed below the VWAP. So we want to play the trade to the downside. So we want to go short. Then we see one candle, two candle, three candle breaking outside of the opening range. So that's a valid breakout. And in 2 minutes here, we have a really nice retest with nice low decreasing volume. So everything respected here. We can see that on that trade, I entered as close as I could from the opening range. My stop loss was just a little bit over the VWAP. And I was able to catch a nice 2R and all the way down to 149 here. So beautiful breakdown on AMD using this magical strategy. Super simple, super straightforward. Here's another example on Tesla. I mean, those setups are happening literally every single day. It's amazing the way this strategy works. So we draw opening range, which is the green box I have on the chart. We have our valid breakout with one candle, two candle, three candle. And lastly, the retest happening here with low decreasing volume. So I entered to the short side and was able to catch a really nice move here, all the way to almost 350. So here is the last example on RGTI. So I want you to analyze the chart here and try to guess, maybe pause the video and take a moment and try to guess if we should have been taking the trade here or not. Should we go long or should we avoid this trade? Take a second and try to think about this one. So here the response is no, we shouldn't been taking the trade. Because if we analyze this together, we have our opening range closed over the VWAP. So yeah, we're long bias. Then we want to see a breakout. We had the breakout here with one candle, two candle, three candles. So that's a valid breakout. And lastly, we have our retest towards the opening range. So here could have been the spot to go long, but two red flags on that trade. First red flags is in relationship with the volume. This specific candle here that went down to retest the opening range, super high volume, above average. So that's a red flag. And for that only reason, we should have stayed away from that trade. The second red flag, if you're using the camera pivot points, we can see that we are in between R4 and R3 here. So we are in a selling range where we have big probability of going back down inside the range. So we don't want to go long here. We want to be short, maybe using a different strategy. So those are the reasons why we should have avoid this trade here. So those are the trade examples I had for you. And hopefully by now the strategy is a little bit more clear. All right, so that was the opening range break and retest strategy. So really simple strategy, really powerful and easy to apply. Especially with discipline, I think it can become one of the most reliable tools you have in your trading trade book. So remember, it's not about being perfect with this strategy. It's really about trying to stay consistent, following the process, and trying to give yourself an edge every single morning. So if you got value from this video, just know that this is only the beginning. I have a lot more content coming up when it comes to either trading strategies, to risk management, and even being in the right trading mindset. So thanks again for watching the video. Feel free to go back and watch it again, taking some notes, and most importantly, practice it. So trade safe, and I'll see you soon.